Hi, welcome to today's tax update brought to you from the Shibuya crossing in the heart of Tokyo, the capital city of Japan. In today's webcast, we cover the most important tax developments for March 2019. So let's move inside and start the webcast.
We will start today's webcast by looking at the most important local tax developments for the month of March. The bills covered in our previous webcast regarding bank loan restructurings have now been voted into law and published in the official gazette on the 15th of March 2019. As a reminder, the scope of tax-free loan restructurings is now extended to include transfers by persons related to the borrower, as long as such transfer is to the benefit of the borrower. In other words, the funds are used as part of the loan restructuring. In addition, a new amendment to the income tax and capital gains tax laws provides that in the case where part of the sale proceeds are returned to the borrower, the respective taxes are relieved on a pro rata basis by reference to the amount used for the loan restructuring compared to the amount received by the borrower. This is an improvement to the previous provision, which restricted the amount of the relief by the amount returned to the borrower. On the same day, 15th of March, another amendment to the income tax law was published in the official gazette. The amendment effectively allows the conversion of a deferred tax asset that arises from tax losses transferred to a bank from acquiring the operations of another bank under resolution in accordance with the Resolution of Credit and Other Institutions Law into a deferred tax credit. The legislative amendment results in an improved treatment of the deferred tax asset for capital requirement purposes and follows similar provisions already in place in other EU member states such as Italy, Greece, Portugal, and Spain. Moving on to what has developed to be a very hot topic these last couple of months. Yes, we are talking about the application of the law in respect of the contributions to the new General Health Care System, ESC. During this month, the Health Insurance Organization issued a number of clarifications, the most important ones being the following. With respect to dividend income, actual or deemed, there is no distinction between domiciled and non-domiciled individuals. As such, the tax residency of the individual as defined in the income tax law will determine whether such individual is subject to the contributions. The fact that an individual may be non-domiciled will be irrelevant for these contributions. Deemed dividends are subject to ESC contributions, which will be deducted from future contributions in respect of actual dividends paid from the profits that have already been subject to the deemed distribution. And finally, citizens of the European Union who are insured in another member state and hold an A1 certificate which exempts them from contributions to the Cyprus Social Insurance Fund are not subject to ESC contributions on such emoluments. We will now have a quick look at some tax treaty developments. The tax treaty signed between Cyprus and Saudi Arabia has now entered into force, and in accordance with the entry into force provisions of the treaty, it will come into effect as from 1 January 2020. The details of the treaty have already been covered in a previous webcast. Moving on to international developments, in late February, the European Court of Justice issued decisions in 6 cases concerning the Danish withholding tax treatment of dividends and interest and the concept of beneficial ownership in the context of the EU parent subsidiary and the interest and royalty directives. The court held that EU member states should deny tax treaty relief provided in the directives in situations where taxpayers use the directives for abusive or fraudulent purposes, even when there are no specific domestic law provisions targeting such abuse. On the 12th of March, the EU issued a revised list of non-cooperative jurisdictions for tax purposes. The revised list includes the 5 jurisdictions already on the list, namely American Samoa, Guam, Samoa, Trinidad and Tobago, and the United States Virgin Islands, and the following new added jurisdictions: Aruba, Barbados, Belize, Bermuda, Dominica, Fiji, Marshall Islands, Oman, UAE, and Vanuatu. The list is concluded based on each country's level of compliance with international standards on information exchange and adoption of relevant measures in countering harmful tax practices. No or nominal tax countries were given until the end of February 2019 to put in place the relevant legislation, and while the majority of the latter countries added to the list have legislated economic substance rules on time, the UAE is one that has yet to do so. We will close off today's tax update with a brief reminder of the deadlines coming up. The 31st of March is the deadline for the electronic submission of the income tax return for companies and individuals preparing audited financial statements for the tax year 2017. However, in accordance with a notification published in the Official Gazette dated 26th of March, this deadline has been extended to the 30th of April. The 30th of April is also the deadline for the payment of the first installment of the premium tax for insurance companies in the life business sector for the first quarter of 2019. This concludes our tax update for this month. Thank you for watching.